Welcome to the Weekly Notebook Review. I am Robert McGroarty. This podcast takes on a bit of a different format where we are live each week on Twitter Spaces. I crack open my notebook and review Hedgeye research with anyone who wants to learn a better way to invest. We feature both Hedgeye power users as well as some special guests that might pop in. If you want to learn more about our research, visit hedgeye.com. If you'd like to participate in the live stream, follow me on Twitter at HedgeyeRJM. Now, let's review the data.
Good afternoon, everyone. It is 4:30 on April 12th of 2023. We're about to begin another weekly notebook review. I hope everyone's had a great day and stayed patient and calm and executed dispassionately out there today. We'll let some folks trickle in and then get rocking and rolling. Oh, baby, tell me it isn't so. We got Trend Wizzo. I don't know if he's in listen-only mode. Oh, he's not. He's not, folks. Amazing Trend. It's been a minute. How you doing, bud?
Good. How are you? I hope everyone is having a good springtime.
Absolutely. It's you should see the smile on my face right now, Trend. I'm so excited to have you on here, buddy. Thanks for making the time. I appreciate it.
Yeah, happy to be here. Yeah.
Yeah. All right. So let's dive right into it. Folks can trickle in as they see fit. Again, game 69, April 12th. The CPI print came out this morning. The market reacted accordingly, and we faded it. Pretty simple, really. So pretty simple. I think at the end of the day, it was kind of played out how we sort of anticipated. Certainly on today's move on Wednesday, there's more data points coming out later this week. We obviously have big bank earnings on Friday. JP Morgan, Citi, Wells, et cetera. So should be an interesting kind of Friday as well. But the one component, I guess, that certainly has some folks maybe not chirping, but certainly interested on the old Twitter sphere would be the WTI crude up at 80, just north of 83. That trend range as of this morning was 82.93. So we are now officially, it's likely it's going to close up here. So it'll close above trend. So we've got a new kind of 1 day close above trend. Now that doesn't necessarily make it a trending bullish signal. However, it's something of note, something of interest. And I think the main takeaway that I would have for there is that you don't always have to play in something that backtests negatively or poorly in a quad 4 environment. And oil has been kind of that outlier and certainly reiterates the fact that the signal trumps the quad. So it's been that outlier really ever since the beginning of 2022 as we were positioning for quad 4. And it didn't really read and react the way that one would think from a backtest standpoint that it might. And so again, I'm not saying that's what's happening right now. It's just it's really important to review and understand that the signal trumps the quad, and it remains bearish in general, right? So it has to kind of confirm up here, and this likely, or it's very possibly that this could be a head fake right up to the trend line, kind of trying to shake folks out, like we had on gold. Was that probably about a month or so ago? So when was that? That was right around that 1840, 1850 level. 1800-ish level, right? 1820. That was a prime time to be a buyer of gold, and this may turn out that this is a prime time to be a seller of crude oil, but time will tell. And again, I think the most important thing in trend, I think you know this better than anyone, is there's a lot of hunting ground out there, and you don't if it's not kind of going your way, or if it's something's bullish trade but bearish trend. There's likely better setups and other components out there that reflect both a bearish trade and trend component, or conversely, if you want to go long, a bullish trade and trend component. So that's what I would kind of encourage you to do is just kind of have an open mind and really not be necessarily tied to any one piece of inventory. Same thing with Qs. Everybody kind of wants to again, if you weren't shorting into the month end markup, or kind of the month end markup or the kind of the most recent peak in the Nasdaq in March 31st. It doesn't mean that you can't press your shorts now, but there's an eyeball premium there as of this morning. So there's potentially other better hunting ground, and in RTA, Keith went after the financials. So XLF was a better place to be, and he even called out REITs in terms of XLRE, which had a negative 12% eyeball discount. XLB Materials is on the ETF Pro short list at a negative, also a negative 12 eyeball discount, but that one's at a negative 1.2 times on a trailing 12-month Z-score. So that setup looks a little bit more favorable. XLF is the best one out there at negative 1.4 times on a trailing 12 months as of this morning. So again, you can pivot, move around your inventory in terms of where your what pieces of inventory you're going to put in the portfolio. So with that, trend, maybe we'll go kind of old school, and I'll toss it back to you, see kind of what you're seeing on the board, and then we can run through some other big asset classes.
Hi, Robert McGroarty here, Director of Subscriber Development at Hedgeye. Hope you're enjoying our podcast. Start generating alpha with our suite of Sector Pro investing research products. Dive deep into retail, industrials, technology, and everything in between, with exclusive access to the sharpest analysts and actionable ideas on Wall Street. Go to hedgeye.com/research to subscribe. Enjoy the rest of this episode.
So, first of all, glad to be here with Hedgeye Nation. Feels great. And secondly, from a standpoint of overall trends that I'm looking out for internationally, there's some unusual bullishness in Europe. The levels that have started popping up, especially on the major economies in Europe, UK, Italy, France, Switzerland, they're showing extremely resilient signals from a standpoint of where their stock markets are moving. Also includes Germany, believe it or not. Moving down to the ones which are weaker, there's considerable weakness which is being exhibited, and almost a topish kind of pattern which is being exhibited in Hong Kong, China. But keep in mind that those economies are having actually interesting fundamental setups, so fundamental macro setup. So do Taiwan, Hong Kong, China set up as a short? I don't know. We'll have to figure out. And as a derivative of those, EM becomes, because EM is very heavy on China, it becomes like a natural place if EWH or FXI end up becoming shorts from that standpoint. Now, I haven't pressed shorts on those yet, but still waiting, observing, the OODA loop in general. From a standpoint of the sector positioning for US, clearly youths are outperforming in general. From a momentum standpoint, healthcare is doing quite well. Financials the weakest, right? And within financials, be it the money-centered banks or be it the regionals, it doesn't matter. It's just across the board chaos. Every time Blackstone comes back up to like 84, 85 levels, it's almost like a game of whack-a-mole. You hit it on the short side, it melts, you cover. You hit it when it comes up, it melts, it comes back down. I don't want to be short going into the print for any of these financial names, partly because if they actually do pop up during the earnings, they would offer some good opportunity to consolidate and create short, and also partly because they've been good, good hunting ground for shorts for a while. So I don't want to overstay, you know, in that mode or in that mindset. So I definitely wait for some of the earnings situation play out. The other part is, I think there's some interesting dynamic happening in the XLP space or the constituents of XLP as well, because some of these companies are able to pass on their price increases, and that makes them fairly interesting. I'm also on the lookout for the defense names, especially with the China tension growing, very much looking into the holdings of XAR, which is defense and aerospace, as well as ITA. I like XAR slightly more than ITA because of the weightings of the holdings. You can look it up on how the ETFs are structured and what's heavy in some of those versus others. Other than that, within currencies, I think the euro dollar is presenting an interesting turning point. I'll let Rob provide more commentary on that. Amongst treasuries, I've been consolidating some positions, especially in call verticals in IEF, and which is 10-year, and IEI. I think that those yields come in more. Not from here, but I've been working at those from the 4% mark for the 10-year using options. I think TLT might make its way back up, which is longer duration, right? 20 years plus, almost to like 120 plus. So I'm trying to structure an options trade for almost a year out of 105, 125 call vertical, trying to subsidize it by selling some puts or put verticals uh, to get a very interesting risk reward setup. So something worth watching for in the yield space, playing rates with options, with convexity. So those are something that are top of my mind. I must admit that I've been getting Europe wrong quite often. So I've reduced the exposure as a position size for some of those quite significantly from the beginning of the year. So European positions don't have more than 3% exposure anymore. Currency wise, I've been just focused primarily on USD JPY and some degree UR USD. That's about it. Rates wise, I already discussed mostly in US Treasury. I'm not focusing anywhere else. I did share, I think on Twitter, I did share my SJB TLT trade. In a few days from now, I'll share what the outcome of that has been. It has just been generating alpha. So definitely keep a lookout for that on my Twitter. Back to you, Rob.
Hey, I missed that. So are you long TLT and long SJV? So you're short high yield, long.
Yeah, so the idea is that the credit spreads eventually will widen,
Yep. Yep.
right? And the idea is that SJB will also give you benefit. The reason for structuring it that way is because what happens is when your rates come down, just like uh, you know recently when the yields came down from 4% on the 10-year down to 3.4 or lower, SGB can take a hit, right? Because the entire yield curve comes down without any credit event. So that's why, and that's where your TLT helped you a lot, right? So or IEF helped you a lot. So you could do an SJB IEF trade as well if you don't want too much alpha, and you could do it, you know, in a form which is in a certain ratio because they move quite differently. Like the beta sensitivity of TLT is much higher for SJB versus IEF. So SJB IEF is also a good pair. SJB TLT is also a good pair. Just making sure the ratios are right. But yeah, basically the bet there is that eventually credit spreads would widen and you'd be able to capture alpha. And the reason for a pair trade instead of just going long SJB is because SJB can actually suffer really bad if overall yield curve comes in just like it did now.
Yep. That makes perfect sense. I like it. Awesome. So yeah, let's roll into. Okay, so you briefly touched base on currencies there. I think the yes, so some of the European ones are, again, you got to remember. I think we talked about this last week. The euro or just the currency pair in general in terms of what you have on, it can impact the U.S. listed ETFs. So any of those European shorts. I'm not sure trend. If, I'm assuming, I believe you typically use the ETFs. I know we do in terms of here at Hedgeye, in regards to shorting, some of those European things like EPOL or EWD, and Finland, something like that. But again, you've got that FX piece as well, and the dollar has has had some weakness in the last couple weeks, and that does basically offset or kind of exacerbates the ETF exposure through on the European side. So you just got to be kind of conscientious of that. But again, this dollar, traded, it closed down around 101.53 to 4 today, and that loan to risk range was 101.15. That was a lower low and a lower high as of this morning. However, we're kind of right at a similar level that we saw in late January and going back to late May of 2022. So if history repeats itself, or maybe it rhymes, it's not always the same. It doesn't repeat itself, but it rhymes. Who knows? All I know is down low in the risk range and remains bullish trend. So again, in terms of coming into the week, the Dixie is down about 2.4% on a 1 month basis, about 2% on a 3 month basis. So it had lost kind of 1 month and 3 month sort of price momentum. In the early look, we Keith shared that it was a bearish trade, but bullish trend and tail. So again, I don't have the trend on the dollar, a recent one, so can't really share that where that is. But again, I see Leslie out there out in the crowd. She's the one with the calm head down when it was down right around 101.03 or so, and it kind of broke down below, right around that level, and helped everybody calm the nerves and stay the course. I think the quad 4 horizon is certainly one to be very conscientious of. The inflation component was certainly last year's story. The 2023 gravity and the recession risk rising is what we're most focused on moving forward here, and whether it comes out in this upcoming earnings or perhaps it's later this year. Steiner did a really great job on the macro show this morning, walking folks through the conditional probabilities of the various quads and how that kind of plays a factor in the data points that are out there, and how things can adjust. And we're seeing a high probability of quad 4 in Q2, and then it becomes a bit of a toss-up for the back half of the year. It's currently a quad 1 on the board, but it's a very, very tight race there, and the data points that come out will influence sort of how that conditional probability will adjust and shift. So again, Chris Moyer, I see out there in the crowd as well. He's mentioned this a few times in the last month or so, that the dollar was the story of last year, and perhaps there's a new story that's going to play out this year, and not saying it's not going to be an outperformer to some capacity, but perhaps not the kind of alpha generator that was 2022. But then again, maybe it will. And the Fed certainly is in a position now where the inflation is still elevated, and although it was a weaker print this morning, it's still elevated, and their target rate is 2%. So they got a lot of work to do. Our nowcast inflation model is saying that we're going to drift down towards 4%, and then down towards 3.9% by kind of Q4. And again, the data points as they roll out will influence that model, and we'll see what happens. But higher for longer is certainly the, I guess, quote unquote, saying or the thought process that we're deploying. Higher for longer, both on the Fed funds futures, but higher for longer in inflation. The crude oil, what's happening in that price movement is certainly, that's the number 2 weight in terms of inflation, behind your equivalent housing, your equivalent rent, and so owner occupied equivalent rent. And so those two components are staying elevated and sticky, and therefore that's going to kind of influence the inflation number, and just kind of keep that in mind, right? So higher oil, it doesn't really help the desire or the need, the quote unquote need to cut rates. And unless unless Fed sees other things, or again, we've also mentioned this as well, where if the Fed cuts, even in the face of higher inflation, and they cut rates, then that means this recession is even worse than we were anticipating. So just keep all that in mind. I think that's So I'll just kind of leave it at that for now.
Yeah, and I think from a standpoint, just to build on that, from a standpoint of what the rates futures markets are indicating, if folks want to go in and search on their favorite search engine for CME Fedwatch tool, it is still reflecting a fairly high probability of a 25 basis points hike in May, when the May FOMC happens. So definitely keep that as one of the data point to check. I almost check it every day, the CME Fedwatch tool. What it does is it backs into using the futures markets on rates. It backs into the probability of what the Fed rate path is going to be. So it will literally give you, for every FOMC meeting, what are the odds that uh, there's going to be a hike or a rate cut or so on and so forth. So from that standpoint, definitely keep an eye out for that CME Fedwatch tool.
Yeah, awesome. And then and the move index as well. It was off. It was off about a little over 7% today, 7.23. So that's a good kind of leading indicator as well. It's obviously well off its highs of almost 200 about a month ago. So keep
I think move would be fadeable because move spiked up primarily because folks were caught on offsides,
yeah.
right? Like Bob Weinstein recently had a very interesting tweet where he mentioned, so Boaz Weinstein of Saba Capitalist, kind of legend, especially from the 2008 days, when stuff happened and the GFC, the Great Financial Crisis. Um, he had an interesting tweet that, okay, Wix is sub 20 while your move is at kind of almost all time highs. So he was trying to figure out if there's a trade where he could get the premium by selling that volatility, the rates volatility, to fund and buy medium term equity volatility, because they were completely at opposite ends. And when I was digging deeper more and more, I found out that there's several levered funds, such as the Jupiter Fund by Hyder. He made like over 100, 180% something last year. He was down 32% because these are like levered funds trying to create alpha returns for their LPs in order to uh, get the boost in their returns from rates. Uh, and then also there was another famous hedge fund called Graticule, which completely went bust because of the basic volatility through which is reflected through move. So what I'm trying to get to is that the uh, market signals when it comes to move is kind of broken, partially because a lot of these folks were forced out of their positions, um, and that caused the entire uh, rates complex to go haywire, generally speaking. And this happened primarily after the BTFP declaration, because the moment BTFP was declared, everybody started running towards the uh, you know uh, fences for when it came to rates, especially on treasury. So just keep that in mind, that some of the market signals may not be reflecting exactly what stance you may want to take.
Yeah, I mean, I was just more so referring to it in the fact that it's well off its highs. It's becoming, broke the last trade level
Yep.
that I have from Keith in the last sort of 5 days, 10 days, and it's trending in the right direction. Trend, I don't disagree. There's potentially different ways, better ways of or not saying it's not it's a perfect, correlation, what have you, but certainly, volatility is kind of coming out of that complex. The longer duration is really starting to work, and you're seeing that kind of reflected in the volatility, and those are all good components in terms of kind of having them inside of your portfolio. That trend level, or the key line there, is 121 on the move from Keith last week. So just keep that, again, that keep that in mind. you're seeing, so again, you've got lower highs on the 30-year at 3.76. That's a good signal. Lower low in the 10-year at 3.22 this morning. So again, all these kind of signals do back up. Although trend, you're right, like in terms of the Fed, the 2-year is neutral and put in a higher high. So that top end of the curve on the US 2-year is 4.26. I mean, it's very possible that we see that. That's a high probability. It's the immediate term risk range, right? So again, there's going to be kind of perhaps a confluence here that occurs where you've got the Fed raising rates, and as you noted, there's a 25 basis point kind of hike expectation happening for the next meeting, and so I mean we're going to go. But that takes it to what, 5 to 5.25, I believe, if memory. That's right, Trent? If that,
Yep.
yeah. So again, this is sort of playing out. Yield curve will certainly become even more inverted, and you're again, if the longer duration, longer end of the curve starts to price in recession risk rising, and the shorter end of the curve obviously is reflecting what the Fed is doing. So all these things definitely can play out, and the move can be, or again, the move kind of can be a good reflection in regards to whether or not folks are going to put capital to work into that particular asset class. Along those lines, in terms of volatility, there was a question out there on Twitter on the VIX and sort of the anticipation or expectation of what the VIX is going to do, either in terms of spike or whatnot, or kind of get out of the chop bucket. So I'm drawing a blank on who the gentleman was that asked that question, but the answer is relatively straightforward or simple. I mean, there's two different ways of looking at it. There'd be the immediate term trade range, which you get in the risk range product. So the top end this morning was 22.24, and the bottom end was 18.28. We almost tagged that top end almost perfectly this morning, right after the CPI print. So that was it's always magical. It was not really magic, it's just math, but it's always really impressive when the best signal has that happen. But regardless, that's the immediate term risk range. So in terms of what's transpiring from a spike standpoint, I really wouldn't that doesn't enter a whole lot of my thought process. It's really about like where could it go today, and then you'd have the trend range on top of that, which would be a wider range and a longer duration, because that look back window would be longer. So that'd be kind of the answer. I mean, if you look at what transpired kind of when the bank issues happened, it was absolute spike, right? You went from the 19.5 level to 28ish, and we touched north of 30 during the day, but kind of from a closing price standpoint, 26.5 I believe was the high. So that's the P, or around 26.5. So again, that's a spike, but I think the other component too, and again, I'm kind of learning as I go here in terms of volatility. I'm no expert in that field. I do see Marcus Mayhem out there, and Chris Moyer, who's really the one who's teaching me most of this stuff, or at least putting me in touch with good areas to read and videos to watch. But if you kind of Chris has actually introduced me to looking at the full curve of the VIX, so everything from kind of the 9-day out to 30, out to the 1 year, and Tier 1 Alpha. I believe Mike Green has written some really good pieces along that as well, and looking at the VIX all the way from a 1 day to a 9-day, and I believe he kind of looks at it from like a blended rate standpoint. But that VIX 9-day, which you can track on TradingView as just VIX 9D, D as in David, that's down at 15.90. So again, there is a difference there. VIX closed at 19.08. So the VIX 9-day, that more near-term volatility would be in the investable bucket and not the chop bucket. So just kind of, I think that would be sort of, I guess, the part two of that question is, how or what VIX does, or how it kind of quote unquote spikes. I really don't care. It's more about like where it is and the difference between, or kind of what the near term volatility looks like, as well as kind of the longer end of the curve I'm not sure if that's even the right terminology, but just the longer end of the futures or the contract. So so that's the convexity. So just keep in mind in terms of where those are and what's that doing. I mean, that VIX 9D, VIX 9D back in the March Fed banking crisis, when things kind of blew out. I mean, it had a closing price of 30.93. So, or no, sorry. Is that right? Yeah, 30.93. So it actually closed up in the F bucket, and unlike the 30-day, the VIX. So again, just kind of wanted to address that, and if Chris, if you want to jump up and kind of expand upon that, by all means, do so. All right, so we've been.
So while we
Go ahead, John.
I want to add about a point about commodities, especially in agris. So in ags, so DBA is the ticker for the ETF for that, Delta Bravo Alpha, and DBA. Uh, you know, it piqued my interest about 3 weeks ago when it started giving some interesting moves for my signals, and I tried digging deeper into what is helping it move up, because soybean is not doing that great, but yeah, it has turned the corner. Joe, which is coffee, is definitely pushing the top end of the risk range. Same with Cane, CANE. That's the sugar fund from Teucrium. So sugar, coffee, those two things have been pushing up DBA quite significantly. Definitely worth keeping on the watch list or the radar. I've been trading it on the long side predominantly, and also some futures, especially soybean futures. So from that standpoint, and the sugar futures, soybean actually is not in a great trend. Definitely, sugar is in a great trend. So the base for that future is SB. To have a look. It's interesting that ags are making a move here. Again, doesn't help the Fed's viewpoint, as Rob was saying that if crude goes up and now ags are going up, then it really doesn't help inflation, especially core inflation. So definitely worth keeping an eye. Gold is I kind of missed the bus on gold from an entry standpoint. I'm waiting for it to come back. So especially if GLD pops back down to like 181, 176 range, I'd be a buyer here. But yeah, gold's one of those which kind of slipped away for me. Back to you, Rob.
Yeah, no, absolutely, and just along those lines, I mean, year to date, yeah, just in terms of like commodities, right? So year to date, this is as of the weekend work, so as of Sunday, so that would have been kind of market close on Friday. Copper, plus 5.4, silver plus 4.4. Soybeans and corn were down, negative 2.1 and negative 5.2, respectively. But they're up, plus 9%, almost 10% on the last 6 months on for soybeans, right? And so again, depending on which look back window you're looking at, it's definitely an interesting component, and there's pieces of the inside of the commodity space. Cocoa, for instance, has been been a significant outperformer just along those lines trend in terms of sugar, but cocoa has been an outperformer and had some the consensus in CFTC positioning or long of the big standouts were kind of long gold and copper. So again, it's an interesting dynamic, and certainly not one that screams that inflation is sort of rolling over and that it's going to be kind of sticky for longer. All right, so why don't we open this up? I mean, there's some awesome folks in attendance out there. Marcus Mayhem, Aisha, both from TraderAid. Aisha will be speaking with Keith McCullough next week on investing at our Hedgeye Investing Summit. So just for those listening in that aren't aware of that, that's our 3-day. So it starts April 18th, 19th, and 20th. There'll be 9 guest speakers, everybody from Aisha from TraderAid, co-founder of TraderAid, to to Liz Ann Saunders, to Ben Hunt, David Rosenberg. I mean, the list is quite insane in terms of the folks that are attending. So it's 3 guests a day, one-on-one sessions, meetings with Keith McCullough via webcast. So you can join them live or on demand. I'll share the link to sign up for that webcast, for that Investing Summit series. It happens twice a year. Would really highly recommend you tune in, again, either live or on demand. Should be a really great conversation, and yeah, so just want to kind of plug that, I guess, real quick. But if anybody wants to come up, share about what they're seeing out there in the markets, by all means, let's do that. Otherwise, Trend and I can certainly keep chatting. There's still lots to talk about, but I'll open this up for Hedgeye Nation to kind of guide this next little bit of the conversation. And I'll have some water. Trent, how's your baby, buddy?
Doing well. Growing fast.
I bet.
Teething pains.
Oh, really? Teeth are coming in?
Yep.
Quick question for you. How's it impacted your sort of your routine, right? I mean, you're one that puts you got a full-time job here in New York, and then obviously this is a big component in terms of your portfolio management and investing process. How's that adjusted your kind of routine at all?
So lesser sleep, the routine time, I had to become more efficient with that. So I had to cut it down by about 25-30% to free up time for the baby. And had to reduce a lot of social excursions. So that's how you borrow time from other activities and prioritize it to the baby.
That makes perfect sense. I've been there. I think many on this call have.
Yeah, you have 2 of those.
I got 2. It doesn't really slow down either, Trent. So not to be the bearer of bad news, but it's you just kind of got to make it work and prioritize those. The family time is a huge component, and then kind of compartmentalize those days, right, in terms of the schedule and timing and.
Yep.
Yeah, and I know you and it's been you and I don't really do a whole lot of Netflix, so that's or if we do, it's on in the background as we're doing our work, right? So it's but anyway.
Hey, I see Brian and the
Muni guys in there
listeners as well.
Nice.
Yeah, so
Hey,
Brian, why
come
don't
on
you
up.
come up?
He was a little mad at me
Give
that I
us
didn't tag him
the
yesterday. I thought he
SNF.
was traveling, so that's why I didn't tag him, Trent. But I don't know if he can talk, but we'll invite him up here. Hey,
you might hear birds and stuff. I'm out walking. I just got done.
No worries, it's good.
Grinding.
Springtime in Kentucky, right?
Oh my God, it's absolutely gorgeous this week. Keeneland's running. I mean, bourbon's flowing. It's just it's the good time.
On Bloomberg, I don't know who it was, but they had somebody up there talking about munis, and I was like, that's not the right guy to have on. We got the Muni King. The Muni King comes to Hedgeye and Friends. He doesn't go on Bloomberg TV, right?
No, they probably wouldn't like what I have to say.
Brian, yeah. So why don't you lead the charge on kind of what you're seeing out in the muni space, if you don't mind?
Yeah.
And the SNF.
I don't really have anything prepared, but I did put out a tweet earlier this week. I called one of our underwriters that we work with, just kind of some color. And the supply has been pretty low. It's kind of been in balance, but the buy side's a little weak. And the long end of the curve is the most difficult to get done. But, quality credits are getting done well. Known names, they said that people were comfortable with were getting done. And very state specific, states that you don't see as much issuance out of, as opposed to, they specifically said, like Texas and California and New York. Those states are a little bit more choosy on the buy side. But deals are getting done. It's like what we've been talking about on the corporate side, not as aggressive on the municipal side, but that you're starting to see that divergence between quality and I'll call it speculation, but it's not really what you would call speculation on a corporate angle. But deals are getting done. We sold some deals this week, and they got done well in Kentucky, and we've got a bunch coming in South Carolina, and they all look fine. So, good credits are doing well. SIFMA reset today at a 217. If you remember before, we were talking, well above 4.
Yeah.
I think we were at like a 435 at one point. And so that's just been crashing down, which every time I kind of see that happen at some point, we seem to get some equity pressure. And I'm hoping we finally start to see that equity pressure. And then on the fund side, they're holding in on the NAV, and seems to be the volumes there. It's not suppressed from what I've been seeing on the funds that I followed. But I'll tell you the biggest, I didn't buy any. It's the biggest miss is the CD market. It is just, rates have cratered in that market compared to what you were seeing. When we were seeing that, I think it got up to like a 535, 1 to 2 years monthly pay. Those are gone. The best you're going to get's like 1 year, and it's going to be sub 5 now. And and it really kind of started when the HTM facility. I'm a big proponent of barking collars for dogs. When they opened up that facility, it just seemed like the CD market just instantly seemed to change. So clearly, in hindsight, they were raising cash, and I didn't really know why. I asked some people; they really didn't kind of know why. Then the why sort of surfaced with it all coming to a head with Silvergate, and then I think the Fed provided liquidity, and that's why the CD market's a lot different. Plus, I think people recognize that everyone was piling into the 2-year short trade, and the duration was what to lock in, right? As we continue towards quad 4. The other thing that I tweeted out is I noticed the money market rates on Fidelity that I'm in dropped a basis point, and so I'm going to watch that like a hawk, but I just thought it was interesting that we saw a decrease by 1 basis point. So I know a lot of people are in cash. I know every now and then they send out the Macro Pro positions, by weight, and the specific money market account is listed there. And so, I would just say watch the rates and see if you get some changes. But that's what kind of it for me. It's been pretty, it's pretty kind of boring-ish. The space that you and I did, Robert, where I showed I like to buy 4s at 4 1/4. That 4 1/4 is now like 407, 406, somewhere in there. And I wouldn't be surprised here if we see what I was saying, which is 4s are not going to price at par or less. They're going to start pricing at a premium, and then everyone's going to assume the 4s are going to be refinanced at the call date, and you'll see that kick, and you'll see the kick in the NAV where your bond that you bought at 95 to 97 is now pricing at like a 102, 103, because the yield curve has just changed. So, kind of a good lesson. But that's really it for me. I don't own any equities right now, not a single one. And I've been just kind of hanging out and just sort of waiting. I feel like something is brewing. Malinsky moment, a credit event. You could just feel it. I did forget one thing on the on the real estate side. So I got a message this morning from a company that I bought a Disney timeshare. I own a few of them through, and they noted that for the third month in a row, Disney did not exercise their right of first refusal on any contract, which Disney has the ability to have right of first refusal to ensure that there's no real bottom selling going on. So they kind of are able to keep a decent secondary market price for their theme park, in particular their theme park timeshare resorts. So that's a pretty big deal for me to see that they didn't buy a single contract for the third straight month. I saw a decline in the secondary market pricing, and that was a signal to me. And then just on the personal side, I was negotiating a rent on an office space and just didn't work out in terms of another tenant that was coming in next door. But the conversation I was having with the landlord and a new project that they're doing and all just sort of gave me a feel that, the corporate credit crunch that we've been all commercial real estate credit crunch that we've all been talking about, that it's happening. I could just feel it in the conversation of us kind of pulling out of the lease and them not having a tenant to replace us. So I just felt like it was the first time that I could actually feel it in somebody's voice I was talking to, not full on fear, but just kind of like, just a little bit of discomfort, I'll call it. So that's kind of it for me, guys. Hope you guys are doing well.
Hi, I'm Keith McCullough, and I wanted to introduce you to my favorite product at Hedgeye, the Macro Show. Why is it my favorite product? Well, it's my show. I do that every morning. If you want to get ready for the market day, you want to contextualize all the data, you want to make good decisions, then this is what you should be watching. It's a repeatable process that you can deliberately study, measuring and mapping time series to time series of data. So it's not going headline to headline and getting whipped around. It's actually being so much more dispassionate about it and making good decisions that are data driven. So we'd love to have you on our team. Come join us.
Tune in weekdays at 9 a.m. Eastern and on demand anytime. Go to hedgeye.com/research to subscribe.
Yep, Brian, that was a great update. And the SNFMA rate, right, like the SIFMA swap index rate going down, does the pressure on the equity on the downside happen immediately with a lag? This is just for the sake of the audience. You and I have spoken about it, but if you could explain that mechanics, that'd be great too.
Hey, Brian, I quickly muted you just so we could hear Trent's question while it was just a little windy. Sorry, man. There you go.
I'm sorry. So Trent and I have worked on different kind of analysis to try and figure out where really kind of money flows were going. And we were looking at the weekly SIFMA rate, and then I've merged that to the weekly SIFMA rate and a daily rate bond that it actually resets every day to kind of track it. So when it peaks at that 4+ point and then rolls over, if you were to kind of look for a high mark in, say, technology, as it continues to go down each week or each day, it's been sort of around the 20-ish day, like 20 to 25th trading day, you kind of have hit a low for kind of an interest rate cycle, and then it would then reverse and it would start going up. We're still on a downward trajectory with the 217 today, and 320 trend was the high in Qs. 320 and change was the high close. So we're below that, right? But it still would suggest that there's more to go, because we haven't seen a reversal in the interest rate. The interest rate is increasing to try and attract cash. It seems to be continuing to decrease because there's more cash going into it. Does that make sense?
Yep, it makes sense. So what Brian just said, I've tried putting a couple of his tweets in the tweet nest. Take a look. The two tweets include both. One has the SIFMA rate. The second has the daily bond, which he was talking about. It's a Delaware bond, and definitely keep an eye on those things as few of the metrics which have some cross-asset correlation. So something definitely worth keeping an eye on while you go through your cross-asset notebook.
Hey, Trent, can I ask you a question?
Yeah.
So 2 weeks ago when I was on, I asked everybody this question and you weren't on. So I'm going to ask you the question. Could you tell me what is the biggest mistake most new Hedgeye subscribers make in their process?
In their trading process or in their investment or just in the...
Just the biggest, like what you run into the most, like it's, like position sizing, right? Like
Yeah.
either trading or even if it's intermediate or, tails a little bit harder, but just what's the hardest thing that people run into, the biggest stumbling block on the learning curve with the Hedgeye process that frustrates people and takes a while to learn?
I have not done any recent analysis, but I think a couple of years ago when I was looking through the arena, or maybe last year, I don't remember, um, what I noticed based upon folks putting out their experiences was that number one was position sizing. So, for example, they'll look at the RTAs coming through. Let's say if there's 15 shorts and 3 longs, they would misconstrue it or conflate it with it being a portfolio and think that the entire portfolio needs to be super short. I think sometimes people get also pumped up when they listen to some extremely seasoned speculators uh, and think that, okay, they need to be minus 150% net short or whatever, right? So that kind of throws them off quickly because then they're not doing good risk management. So primarily speaking, risk management, position sizing, understanding that the count of uh, signals being sent out on RTA is not a portfolio, and having a large cash component also, and also having moderated expectation of returns is important. So if you ask me what is the biggest stumbling block, I would say tempering expectations with respect to returns is one of the biggest challenges that folks have, at least based on my observation, based on what chatter I've heard on the arena.
Okay, thank you for that. So I don't think I answered the question last week. I was just asking questions, but my biggest frustration, and I ran into it again in January, is the position sizing. I've gotten better. I mean, how bad could you get when you have no position sizing in equities right now, right? Like it's really hard to screw that up. But yeah, I mean, I closed out all my shorts last week when Q's had a red day, and the one thing that I'll say, I had an interesting phone call yesterday. Most of my phone calls are with people more in my age group of 50 plus and fixed income and, wanting safe and secure income for whatever lifestyle needs that they're seeking. But I had a conversation with somebody younger yesterday, and it struck me that the speculation, the living through zero interest rate environment and not fully appreciating risk adjusted returns was something that I think some people they misconstrued what a decent return is in a normal market. I guess is one of the things that I would say that I see as kind of an error. I think people need to be more measured in what a reasonable risk adjusted return is and what it's not.
Right. And to that effect, I was, I think a few weeks ago, I was sharing, I think around 31st March or 1st April or something. I was trying to share on that space that when fixed income or CDs were yielding 5.4, keep in mind that the distribution of outcome when you have CDs is not that wide. Whereas if the earnings yield on S&P 500 at 18.6 next 12 months multiple uh, is about 5.5%, and the distribution of outcomes is too wide, meaning you could have a pretty decent downside. So from that standpoint, with a rather limited upside. So from that standpoint, what I was trying to get to that day, and I think it was misunderstood, was that weighting the risk adjusted return more and having the right assets is the key. So asset allocation is the key to your success, as Warren Buffett constantly keeps saying. So definitely structuring your portfolio such that, for example, if somebody tells me today that, I'm going to get 5.4, if I could lock in for, say, next 9 months, 12 months, whatever that CD is, I would definitely take advantage of that. And, I did jump onto a bunch of CDs when they were available at 5.3, 5.4, keeping all of them within the FDIC limit, of course. But that is a pretty decent return, especially if you don't plan to do anything with that capital for the next 9 to 12 months or maybe longer. Of course, there's refinancing risk because you won't be able to refinance them at the same rate. But who knows, at that time, equities may become more lucrative and available. So I agree with Brian on 100% that risk adjusted return, as well as setting up the right expectation for risk adjusted return, is absolutely key.
Yeah, I'm going to be down in Atlanta at the Private Wealth Forum with David Salem. There's a whole Hedgeye crew going down there on April 26th, and he's got one of the things that we're going to be talking about is the threshold questions for principals, Brian, there's 4 questions there all around real return swap, drawdowns, aka how big a drawdown would be too big. Relative returns and uninvested cash, right? So different components there, and I think it's a really great way of thinking about it, Brian, in terms of what is your real return swap, right? So what's if you had to if you kind of had a 25-year holding period, right, cost free, a right to withdraw capital is desired for consumption. What would that number be, right? So if it's a guaranteed return rate, net of fees, taxes, and inflation. What would be that swap number for you? And so I think it's a really interesting way of thinking about it in terms of I mean the desire or the need to get 10, 15, 20, 100% returns. I mean, it's just kind of absurd. It's all about our core fundamentals, which I know the two of you certainly wholeheartedly believe in, which is preserving your hard-earned capital, protecting that hard-earned capital, and then compounding it, right? So and compounding it in the highest probability ways possible in terms of leveraging the signal and the quads as back tests. I think it's going to be a really interesting conversation. I think we're going to meet some really great family offices and RIAs and private banks down in Atlanta in a couple weeks. And again, this threshold questions for principals is something that he shared with me, and I think it's a phenomenal way of thinking about it.
So, what's the plan on David and asset allocation and that new product? Has there been any movement on?
No, I mean, we're still working on fine tuning the what that looks like. It's called Capital Allocation Pro, and I mean it's on the horizon. We're working on it. I mean the focus is going to be more on kind of trend and tail duration, so that longer time frame. Obviously, trade, is something that it plays a factor in regards to, it's available, but it's certainly, the focus is certainly more on that longer term type horizon and catching those big, the big cycle moves and across like some of the bigger core asset allocations, right? So that's going to be kind of that's the general gist of the product, it should be good, should be really great. I'm quite excited about it.
Me too.
Yeah. Nate's coming up. Sorry, Nate. I was daydreaming there for a second. Hey, Nate, welcome.
Thanks, Robert. Hey, I started back in January, and I just had a quick question. Reference that capital allocation product.
Yeah.
I'm not sure how many of your subscribers are federal government employees, but with the TSP restriction, yeah, I know, but they only let us do mutual funds. We can't do the ETFs.
Got it.
So I was wondering, is there any way to have some type of chart that will show, hey, I buy this ETF in my non-TSP accounts, I can buy this mutual fund in my TSP mutual fund window? Thanks.
Yeah, Nate. Yeah, good question. And in general, I mean, the answer there is really, we even currently. So let's just look at what we have today, right? So if we use ETF Pro as an example, you've got your longs and your shorts. Obviously, in that type of account, you can't have, you can't short. But on the long side, you've got some core. What are we at today? We added 5 this week, so we're at 2, 4, 6, 8, 10, 11. So we're around 15, 16 longs, right, in that book. So what I would recommend, and certainly what I've done as well, because I've been in similar shoes where I was restricted in regards to what pieces of inventory we had access to. It's looking under the hood in terms of what mutual funds you have, right, and then what exposure do they have, and so where we are longer duration, a very common mutual fund would be some form of a bond mutual fund, and you would want fixed income fund, and you'd want something ideally slated to the longer end of the curve, right, Nate? So that's one really great way of kind of taking what we have today, and again, the red or the shorts are really more of a stay away type thing. So kind of divest as much as you can, and so if something's got heavy exposure to tech or growth or even just factors exposures that don't back test well in a quad 4 environment, like momentum, growth, high short interest, those type of cyclicals, right? Cyclicals are a huge thing that we've been talking about recently in regards to industrials and materials and steel companies and just the late energy and the late cycle pricing that they've been beneficiaries of, and margins reporting the high, Caterpillar and Deere reported the highest margins in history in their last quarter. So kind of staying away from that type of exposure. So some of that work is going to kind of have to be on your shoulders, right? We can only do so much here, but in the capital allocation, I understand what you're asking for in terms of that capital allocation model is a bit more broader, right? So again, we haven't narrowed down exactly what we're going to deliver, but we hear you. We've heard that from a number of existing subscribers in terms of kind of broader market asset allocations and trying to come up or kind of delivering something that will help folks make those trend duration and tail duration decisions.
Yeah, I definitely appreciate your guys' efforts trying to help us out like that. I mean, your normal ETFs, gold or aerospace and defense, yeah, there's mutual funds for that I can find. But when you get into these ones I've never heard of, BNDD and BTAL and those types of things, just trying to mirror the Macro Pro list, it becomes challenging. So anyway, I just want to say thanks for all you guys do. And, I'm learning a lot. I've been doing it for a whole 3 months now, so I appreciate everything you guys you're teaching us.
That's awesome, man. Yeah, and I appreciate that. It's I'm glad thrilled to have you as part of Hedgeye Nation, and we're happy to have you. So, in terms of just the BTAL, again, if you go to that ETF, kind of read through it, it's a low beta or an anti beta really component, right? So it's basically short S&P. If you can't express it that way, that's totally cool. It's a kind of unique instrument, and BNDD is really kind of a little bit more of a lever. I mean, it incorporates. Nancy Davis has a very unique way of incorporating the swaps and stuff there. I believe it's swaps that she leverages. But long story short, it's a bit more of a levered play on the kind of longer duration. So the real key takeaway there from BNDD, when you kind of dive under the hood, is longer duration. I mean, long duration is really the name of the game. If there's 3 things you want to be long right now, it's gold, long duration, and the dollar. Right, so that's it's. Oh, sorry, and China. I can't forget China. So 4. So call it 4. But those are basically the key themes, the core themes right now in our long book are long duration, long dollar, long precious metals. I'll say kind of expand it beyond gold and long Chinese factor exposure. So if you can,
all right,
if you can kind of,
I appreciate it,
man. If you can kind of generally create your portfolio in that way, that's current kind of our current setup. Now that can shift, but that's sort of the current setup, Nate. So hopefully that helps.
So Rob,
yeah, Trent.
Yeah, that definitely helps.
Yeah. Real quick. So with the long China exposure,
Yeah.
right, with what was happening there, and I did hear it on the unscripted podcast. So, and this is not a plug. This is just, I listened to it over the weekend. So one interesting conversation that happened between Felix and um, Ami was that, hey, when reopening happened, what kind of subsectors benefited? And Andrew pitched in specific names like, the Live Nation equivalent in China and those kind of things. The reason I bring this up is because as China reopens and as Chinese factor is a bit on the longer side because of the fundamental momentum of the macro data, doesn't that correlate with European data as well? Because right now, at least that's what is being factored in the market, and it could be mispricing. The European equities are heading up to kind of 52-week highs, partially with this sort of factor correlation that if China reopens, it kind of helps the luxury sector, meaning European luxury sector, because the Chinese buyer from the upper middle class to upper class ends up buying European luxury. And the second part is that Europe provides a lot of exports to China, generally speaking. And I dug into the numbers. It comes out about 28% of their exports are consumed, at least from the Western nations in Europe, by the People Republic of China. So from that standpoint, has there some study being done that, okay, if China factor is bullish, then maybe despite of the European macro data being in the negative momentum, it might get helped a little bit forward-looking wise, conditional probability wise as well.
Yeah. Good question.
And I don't want to put you on the spot. Maybe
No.
that's something which
I mean,
would be explored.
it's real again. I mean, I'm not trying to boil it down to like simplicity, but it's relatively simple in terms of it's one of the only countries in a Quad 1 environment, and it's bullish trend on the
Right.
Shanghai Composite. So, Hong Kong has been flirting with that trend level, and so that's kind of a bit of a different story. We added KWeb for a hot set, or sorry, it's KWeb's long in ETF Pro. It was so we added that this week, and in the re-ring product, you'll see that Keith kind of just, and he mentioned this on the macro show today. He sort of added and then got out of it just from a signal standpoint, but he added a different, the more of the higher quality kind of KBA earlier this morning, right, to add his minimum sizing. So he added that. And again, so we kind of rotated there away from the kind of the components inside of KWeb and more towards the KBA. So the consumer discretionary piece, to me, I mentioned this last week, CHIQ. That's one of the ways of expressing that in ETF land. That would be basically staying away from the industrials complex, which has in terms of a global Quad 4 demand slowing environment and a kind of disinflationary, commodity environment, that would be the way to kind of like structure it. That's certainly how I'm expressing it in my portfolio in terms of long CHIQ and long KBA. I'm actually using PGJ, the Dragon, but that's just because I don't know. I used the Invesco products last time around because I was employed by Invesco and I just am familiar with them, so that's why I kind of went back to there. So there's no real particular reason on the KBA versus PGJ, but Keith is long the KBA, so I would stick with that out there in the universe. But yeah, I mean, I've got in terms of longs, you're going piggybacking off what Brian said. I mean, my equity longs are Chinese related, and adding to some. Do my best to add some staples. That's the next step on the board. I think even staples as well. I mean, the staples factor in Europe too trend are kind of helping the European complex as well.
Got it. I think we got Raj up on
Oh, hey,
here.
Raj.
Raj, over to you.
Hey, how are you?
Good to have you back.
Yeah, Thanks. I've been out for a while here. Um, I'd like to answer Brian's question. I think he
I
posed the
love it.
question.
It was a good one last week
And
too.
yeah, basically, when I started out with this, I used to use Hedgeye, and I always thought about like as if like a holy grail, because I used to invest into like I'm sorry, purchase like these investment letters and all that, and I always thought it was like a holy grail. But until I got to Hedgeye, initially I thought about it like a holy grail, but then I'm like, wait a minute, these guys have a process, and if you think through it, it makes you start learning from it. So initially, I had a lot of mistakes for sure. I mean, but in order to resolve that, I made sure that my investments I didn't get blown out. So I made a rule that if I'm out, if I lose like 8 to 10%, I'm out completely, regardless of what it is. So what happened in this January? So I made money last year, and I didn't want to give that up. But during December, I kind of went a little bit long, quite a bit. I mean, I'm sorry, short. I did a lot of shorts, and it went against me. So I kept on, cutting my losses at that time until I stopped the bleeding. Basically, I got down to -7%, roughly thereabouts. And now what I also have is another rule that, hey, if I take a beating that much, I slow down for 30 days and just don't really trade and look at what mistakes I made. And in that time, things kind of resolve itself, and I start looking at, okay, what do I need to do, and what's the next things I need to recover from. So in March, I start coming back again, and now I feel I'm very comfortable in my positions that by June, I'm going to be making more money on this again. And by end of the year, I expect to be even more. The other expectations that I have also when I initially started was I always wanted to make like 15, 20%. I'm like, I got to stop this. Why don't I just make it like 0 to 5%? That's about it. Zero being like break even. So I reduced my expectations. That gave me more of a defensive type of thought on how not to lose the money. But there are times like over the years that I've gone through that I could be very aggressive now. So because I know the Hedgeye process, I know what Keith's thinking, I know how things are going to lay out. So this is the way I kind of take a look at it. So I look at from not only like a 3 to 4 weeks, but 3 months, 6 months, 9 months, how things would play out, how things, how Keith is talking, and what it's like, and based on his tone or reading early look or whatever, I make my decisions that way. Also, now I also have a lot of pro products, so that's also helps out. So that's my 2 cents.
Hey,
And I do
Raj,
want to
this
share.
is. Oh, sorry. Go ahead, Trent.
No, go ahead. Finish your thought.
Well, I just wanted to say that I totally agree with you. That's pretty much what occurred to me. And, I'll use Bitcoin as an example. I cannot tell you how many times I've been called a boomer because I'm anti-Bitcoin.
Mm-hmm.
And I think it's just, there's a lot of, younger investors that have lived through the QE environment, and it promotes, what some would consider excessive risk taking. And now that we're moving into this QT environment, the older people are kind of like, oh, thank God we're getting back to, what I kind of grew up in terms of environment. And I think the reciprocal, I think the younger folks are experiencing QT for the first time, and there's this risk adjusted process that and getting your mental capacity around that.
Right.
So I 100% agree with what you just said.
Yeah, speaking of Bitcoin, I mean, I got the crypto whatever product there too, and I was shorting Vital big time, and I started getting very aggressive on that, and then I brought it down to my minimum, and then I started going shorting more. almost like 2% or so. And I know it was risky, but then you know what? The Bitcoin started going up. I'm like, then I just cut it. I'm like, I'm out. And I started looking for something else. So right now, if in my book, my computer's not working, but if I remember, I got Brian McGough's retail product there. So I got IPAR. That thing's doing like shit. Now I got to think about, do I just cut that loss and put it into something else, which performs better? So these are the ways I kind of think about things, So, and plus the other thing is, I always was told that, the SPYs always return to roughly around 7 to 8%. And if I had CDs that gave me 5, I'm halfway there. So
that's what I was trying to say. If you got CDs which give you 5.3, then you got a whole bunch of your return objective met.
Right.
And to add to that, I do want to provide like how some folks are sharing their application of the process. I've put in the tweet nest Todd Ender's tweet. He kind of follows it. You can see from some of his older tweets where he used to even provide the exact allocation. It is pretty interesting and fascinating to see how he has done it. I think, Rob, correct me if I'm wrong, but Todd is ex-Hedgeye, right?
I actually don't know.
Okay,
I think so.
Yeah, I think he was ex-Hedgeye.
I think so, yes.
Yeah, and he does it quite well and transparently. So definitely,
We emailed for the first. We
there's a community
for the
called.
First time today, so I don't know, Doug. I don't know. And
Got
so
it.
most of our interaction has
There's
been
a community
online,
on Twitter called Exploring the Hedgeye Process. Definitely, take a look what Todd Anders does, and it might be helpful.
Hey, Robert, can I ask you a question?
Sorry, the mute wasn't coming off. Of course, Brian.
Hi, Robert McGroarty here, Director of Subscriber Development at Hedgeye. Join our entire research analyst team live before the market opens for deep dive investing analysis, our favorite stock ideas, and our risk manager-in-chief, Keith McCullough's macro overlay. Our team of 40-plus equity analysts discuss key market developments, trends, and our high-conviction long and short investing ideas. You will not get this granular level of insight anywhere else. A video replay, audio version, and analyst summary notes from the call are available shortly after each live show to ensure you don't miss anything. Go to hedgeye.com/research to subscribe. And tune in live to the call weekdays at 7:45 a.m. Eastern. Enjoy the rest of this episode.
So, I think some people get a little bit confused on this, and it might be a good little refresher. So the risk ranges that come out each day, that's trade. And then ETF Pro is trend.
Correct.
And I think it might be helpful just to kind of remind people what those risk ranges are, because I think, in the frustration column, when a risk range gets blown out, it may not be blown out on trend, but it may be blown out on trade. And the different, each product has a different, trade or trend risk range within it. And I think some people get confused on that.
Yeah. So as a power user, Brian, I would encourage you to not use the word blown out. The risk ranges never get blown out. They are dynamic, so they're always shifting and moving higher in real time, or kind of adjusting in real time, right? So I would really encourage everybody to not think about it from like a blown out. These aren't static levels. This isn't support and resistance. These are ranges based on price, volume, and volatility. So again, the differences between what we get on risk on the daily, aka the risk range product, is the immediate term basis. So that's the immediate term risk range. So that's basically based on yesterday's closing price on that particular piece of inventory. So whether it be the SPX or the US 2-year, HYG, whatever the asset is, that's based on closing price, and then it's there's a look back window there in terms of immediate, on a trade duration basis, so 3 weeks or less. So again, that is the immediate term. So again, based on closing price. So when those adjust, so if you see price move significantly higher from closing price and significantly higher from previous pricing in the last kind of 15-day window, then you need to be, mentally adjusting your ranges either up or down accordingly. That's because that's one piece of the component. Same thing with volatility. If volatility blows out, and you can look at that from a realized volatility standpoint, is an easy one that most folks should have access to. If realized volatility blows out or moves significantly, in one way or the other, versus where it's kind of traded in the last sort of, call it, 15-day look back window, then that's going to impact your ranges as well. So again, just keep that in mind. So if you're long or short a particular piece of inventory, so let's just say you're short, right? So if you're short, price moves higher and the realized volatility moves lower, then not only is the top end of that risk range going to move up, but the low end is also going to likely move up as well, because there's less volatility in that particular asset, and therefore, the probable range in terms of the immediate term, move, the delta, I guess is it the delta, Chris? Not really, but like the probable move shrinks, right? It's because you have less volatility in that piece of inventory. So just think about it in that way. And same thing with volume. That's why, if you're not tracking, or sorry, I shouldn't be negative. If to think about it in a positive manner, I would encourage you to track, obviously price is a key thing that's on most people's radars. Volatility should be something in there in terms of a watch list. You should have some form of, whether it be the VIX or realized volatility for that particular asset, and then volume, and do so on a varying look back basis. So oftentimes you can see, 5-day percentage change in price, 30-day percentage change in price, weekly, 3-month, et cetera, et cetera. So if you can have those components on your screen, you're going to get a better assessment as to what price is doing in relative to itself over the course of a particular duration. And then if you combine that with what volume is doing, and again, oftentimes you can get, I use something on TradingView called, average volume at time, and it's on a 10-day look back window. You can use varying components, right? So you can do 15-day look back window, 21-day would be a kind of, kind of more of a 1 month, 1 month basis. But again, whatever it is that kind of fits into, or that you find works, you should have these kind of tools that you're reviewing and assessing, so that you can track your volume, you can track your volatility, and you can track your price. So that's how you can kind of adjust things, even though you don't have the keys to the kingdom, and I sure shit don't have them either here at Hedgeye, right? So that's the one piece from a risk range standpoint. And then the trend range is just a longer look back, Brian. So those don't typically fluctuate quite as much because it's a longer look back window. So you've got more price, volume, volatility that's kind of baked into that range. However, with that said, there's always a caveat. Those are also dynamic. So again, if you have a big move in price, this week, what would it be? XOP might be a good example. Yeah, so like XOP, kind of a good example. Last week would have been a good example where the closing price on XOP, which is an ETF, in the ETF on the short side, that closing price was around 127. I'm using rough numbers, but it opened on Monday up close to 133. So that risk range, even though a trending risk range, the top end of that risk range, it wouldn't have been a kind of good reflection as to what that range would have been in real time if you put in that new price of 133 versus 127, if that makes sense. So again, that's how you can kind of adjust and make sure that you're not making a mistake in terms of thinking you're at the top end of the range, but because they're dynamic and ever changing and moving, at least one, those three pieces of the components. And again, I don't know how they go, how exactly, Keith puts them together to get his vast signal. But those are, the three critical pieces that I look at every day. I really don't read shit, honestly. Like, I read the early look, right? And I read all of our research, read our research notes. I scroll Twitter for general, like, headline stuff and just understand what's transpiring and what the market is sort of digesting out there, right? And many of you in Hedgeye Nation, I'm very grateful for. You guys send me, articles or you tag me in certain stuff, and it's awesome because, like, kind of you guys basically curate shit for me, which is awesome. But I literally, I don't know, maybe I'm turned into a bit of a robot, but like nothing influences my decisions other than price, volume, volatility, and that's it. And again, I'm talking about me personally, but I've evolved. I didn't fucking even know what volatility was. I mean, like, I knew what volatility was, but I didn't understand it, how it its impact on different assets before I found Hedgeye in March of 2020. So, I was 15 years before that of doing it kind of the old way: valuations, fundamentals, deep dive research, all that kind of stuff, right? So, this is it's 3 years later. It's basically a 180 in terms of what impacts the way that I think about markets, and where I think positive outcomes have a higher probability of I guess being successful or achieving.
Yeah, and what's the difference between trade, trend, and tail?
Just look back windows. So tail is 3 years or less. The trend is 3 months or more, and trade is 15 days or less. Right, Chris? It's 15 days, isn't it? Or is it 1 month? It depends on the piece of inventory. Chris, you're on mute, bud. You might not.
Hey, sorry, no, I was just listening.
Yeah, so trade is 15 days. 15 days or less.
Yeah. Yep.
Okay, thanks for that. I mean, I think sometimes people get confused when they look at the risk range product and they see the NASDAQ, and then they look at the ETF Pro and they look at QQQ, and you can kind of get confused, right? If you don't understand the difference in the time duration.
Well,
you really don't understand it.
I agree, Brian. That multi-time frame zooming in and zooming out is something which could be clarified. So I think, Rob, what might help is in the university or somewhere, and I think it's there in one of the courses, but just having a clear-cut multi-time assessment sort of a 3 to 5 minute session would be helpful.
I mean, I'm not trying to be defensive. It's listed literally everywhere, guys. It's on the bottom. It's on the bottom of the risk range product every day. It's like it's the trend duration at the bottom. ETF Pro and investing ideas. If you scroll down to the bottom of like where we put out the risk ranges, it says it right there, like the different durations. It's like,
yeah, it's not a question, Rob, of me not understanding it. I think people look at it real quick and they don't take the time to comprehend it fully. That's why they get frustrated.
I got you. I understand. I'm just saying it's written out like everywhere. But yeah, no, there's investing ideas, and I've recorded the last 2 sessions of what we're calling Hedgeye orientation. So that's going to be basically kind of even almost like pre-Hedgeye University in terms of kind of setting out kind of fundamentals and kind of getting your process together and walking folks through and that kind of thing. So it's going to be available for all new subscribers as we move forward, but certainly open to anybody that's an existing subscriber today. So I think that's launching after my vacay and investing summit. So I think that's going live in May.
That's cool.
Yeah. So
if anyone,
Raj.
If anyone as well sorry, Raj, no, go on.
Yeah. So here's one way I learned how to use the real-time alerts, and because I'm not always on time or I'm busy doing something else. So here's an example. And for example, recently Keith had Tesla on. And if you listen to the call and what Jay says and so forth, and their conversations, and pretty much Tesla is bearish. But I think Keith had 2 dots on Tesla.
Yep.
When he had 2 dots, and I'm like, gee, I got nothing. Why don't I take a shot at this now? So this is my first dot. And then I took a second dot. So I'm getting a much better price, but still knowing the fundamentals and the risk ranges. And I know when Keith is going to hit that third dot, he's going to be out. But he may have lost money on that, but I make money on that, and that's kind of one way of doing it. I mean, it's not, you just kind of have to figure things out as you go along, and it takes a while to figure these moves out, so I'm watching. He's basically another player on the court or on a basketball court or something. If he makes a mistake, maybe, but I know what he's doing. So I'm going to take the same play, at a different location or whatever. So these are things I kind of think about,
And Raj, I do 6 dots, so I'm doing the same thing you're doing. I agree with you.
Yeah.
Sometimes I get out of size, so I just went instead of 3, I went to 6, and it's working better for me. So
yeah, that's what I mean. I just gave like for simplicity's sake. I have much more dots than I.
I think most of us do, right? And even Keith does, right? Just like in RTAs, he keeps himself to those 3 dots, those 3 bullets. So it's but in general, he talks about this all the time in terms of like he's touching his position incrementally, even after that first dot. He's still touching his position here and there and that kind of thing.
So,
yeah, Chris.
No, just in terms of like the trade and trend duration, for new subs and stuff in 2020 and 2021, I was making some videos and just a visual representation of that between the 2 products. I made a video where I just showed a visual representation of the trend duration, if you like, the ETF Pro duration against the risk range duration. And that made a big difference for me. That's why I made the video, because it helped me. But just seeing that, yes, okay, we were at the top end of the risk range, the daily risk range, but actually on the longer term duration, we were still right down at the bottom of the longer range. So yes, that might have been a good trade. It might have only been a good trade for a day, a few hours, intraday, something like that, as a trade to make coming off of the top end of the risk range. But in the grand scheme of things, it was actually still in the low end of the longer time frame. So you had to make it a shorter trade. And oftentimes, when we kind of go through these periods where Keith is being much faster, everything kind of coincides where all of a sudden, if you look at the longer time frame in terms of ETF Pro, you'll find that everything's all of a sudden at the top end of these weekly ranges, like all in a big cluster, all at the same time. And that's when you get the larger overall market moves, or it tends to be. So you really have to combine the different time frames to get the best out of both. They both complement each other. I know it doesn't always happen that something's in risk ranges and replicated in ETF Pro. And I think there's a reason.
Yeah,
for
Chris,
that,
but it does help kind of think through the different durations, really. And XLK is a great example where the trend range, closed at 149.07 on last Thursday because it was a holiday on Friday. That range is 154 on the top end to 138 on the bottom end. And this morning, the range was 151 to 143. And so that would have been based on yesterday's closing price, which was Tuesday at 147.59. So, there's a difference there. And you're absolutely correct, Chris, in regards to, it's a really great kind of, you can mentally see it. And to be perfectly clear, you taught me how to, like, that video and us talking is what helped me think through and put that on my screen in terms of like in trading view. So hat tip to Chris. I don't know if I'd be here without you, mate. But we got Dr. Tobin in the house, baby.
Can you hear me?
We can.
Okay.
I think this may be Dr. Tobin's first Spaces session, maybe a second. But how you doing, man?
I'm good. It's a long-time listener, first-time caller.
First-time caller. I love it. What you guys might not know, and Tom, I'm going to share this with you, but Tom likes to play some options for Hedgeye Nation. He likes some longer dated options. Just so you know, we all do like to trade here at Hedgeye, no matter what you might think about what we anyway. But just
well, I'm trying to eat my own cooking, and when when I get when I'm free and clear to deal with these ETFs, so XHS and XHE, I've been dicking around with long call, just out of the money calls and puts and stuff. Mostly calls lately, though.
Yeah.
Just because the estimate momentum has been good, and it seems like healthcare should be outperforming, and the factor exposure isn't perfect, but it's better than average. But if I could deal with pink or XLV, or mainly the XHE is the one that looks the best. Yeah, I'm just messing around with that in my PA and trying to crack the code.
We don't have to get into those details, but yeah, but I think, would you mind just expanding on for those that might not fully understand or fully know your process in regards to how those get rank ordered from a factor exposure standpoint, and you've got a very robust model that you've built.
Yeah, I mean, there's the following key thing is hard, and I think the quads in its simplicity is very simple to understand, but you got to bridge that gap between sort of what's going on the macro level. Okay, it's quad 4. What is my specific ticker going to do? And the way we've bridged the gap in the healthcare group, and I'm hoping to expand this idea, is we essentially looked at, well, first we looked at any metric we could look at, and the second thing we did was decide of those which mattered in each quad. And in quad 4, size matters, so EV matters. There's a break point of about 5 billion on the EV side, and the margins, I think it's mid-teens on EBITDA margins. And then we've got our own little, slope of the estimate line, acceleration, sort of estimate momentum stuff. And if you get those things sort of in the area code of correct, plus you have your, healthcare macro in our case, or fundamental case against that, okay, I'm in quad 4, healthcare should be fine, plus my factor ranking for this particular name, or rolling up all the ETFs that we look at, looks fine. I should be, good to go, right? And then I'm just a dummy. I just use the Bollinger Bands to sort of as a placeholder for Keith's levels, but I mean, it's super crude. It's a super crude substitute, and I don't have time or the headspace to sort of front run him. So I just kind of stick to my knitting and think in like sort of 3-month terms and sort of 3-year terms. And but yeah, so the quad factor thing, XLV has the best quad factor scores because they have a lot of large cap, high margin names. The estimate momentum hasn't been great because of sort of the post-COVID thing. And then Pink is sort of second in the list. He's got a lot of nice looking growthy type names, with the right kind of factor exposure. So, and then surprisingly, there's a lot of not-for-profits in XHS and XHE. And then the ones that look the worst have been XBI and ARCG. And then that's my universe of companies essentially too. But yeah, that's where I'm at. I mean, we've been trying to pick off these, solid quad factor. We call them quad factor longs and shorts, and we kind of rank order our names every week and try to focus in on the names that have a high probability of working, even before I pick up a pencil and try to model it out. Yeah, that's where we are.
Yeah, no, it's fantastic. And Tom, you and I sat down. It feels like forever ago. It was before Christmas, back in December. You were my first sector head spotlight.
Yeah. Maiden voyage.
Maiden voyage. That's right. Back in December. So we walked through in about a 30-minute session. Really dove a little bit deeper in terms of like kind of the way that Tom has created that quad factor model and how he deploys inside of his healthcare space. And as he mentioned, it's something that we're working on. We need some data science help there, right, Tom? So we put that tweet out there again today. So if anybody's got any what is it? What kind of a data scientist are you looking for again, bud?
Well, I mean, we've iterated through this for a couple of versions. I've talked to so many people at this point. We've got a couple of good candidates, though. It definitely, you got to put your reps in. Right, you got to do the interviews. You got to talk to people, and then within the firm, right? So the good candidates get passed along, and then objections and concerns get raised, and then those get answered. But we've been at this for way too long, and it's just been a question of just finding if it's not an enthusiastic yes, it's a no. Is sort of the way I've been treating it because we're at the stage now where we have so many opportunities to, like, my perfect product would be, okay, it's quad 4 across the S&P 500. What are what are the, what's stacked in terms of high probability long and short. Hand that list to Keith. Okay, this is the signal strength. Oh, okay, fundamental analyst, you go figure this out. Give me a narrative, give me a story, tell me which ones are real. But that would reduce my, the hard part, which is picking where to focus my time. And if you're more than halfway there with something that's going to work, heaven forbid you find something that's like going to, double or triple from there.
Yeah, 100%.
I've got a spreadsheet for you.
yeah. The CSV file done. Yeah, and we're working on it though. I mean, there's a lot of things to do with it because we've gotten so far already, and it's like that bridging that gap between the macro quad to the ticker. I think is the that's not last mile, but it's last bit.
Yeah, 100%. Does anybody up here or anybody in the crowd, if you guys have any healthcare questions, it's XLV is bullish trend. Ooh, but with that said, we were shorting one of your names this afternoon into the close, which I know you've been pretty vocal on the call with us, Tom. So thank you for that. So it's we go both ways, right? We can you gotta pay off your book. But yeah, I mean, Tom, I don't know if there's maybe as people kind of perhaps come up in terms of a key theme that you're seeing in for 20, at least maybe for this earnings season or the next kind of next few couple of months. I know you said your duration is kind of 3 months type thing. What's really sticking out to you? Is it really just kind of letting Pink and how XLV kind of these really high quality factors exposures do their thing?
Yeah, I mean, I'm not going to sell much research advocating for somebody else's work on that end, but in terms of the individual tickers, I mean, our broader view is.
I didn't mean it that way, Tom. I meant like that.
No, I know what you mean. Like, listen, I don't want to step. Mike Taylor's a really good analyst and a portfolio manager, and Pink. It's not surprising that Pink is stacked with super high quality factor exposure and estimate momentum. Like, that's just not. That was unsurprising to see. But in terms of what we're looking for is, healthcare has been ball underwater through COVID for 3 years now. And, a lot of people have avoided care or delayed care. And there's the suppression between COVID and labor shortages has been pretty severe. And I what I'm hearing anecdotally and what I'm seeing in the data is that marginal consumption is breaking out. Labor is getting easier to hire and to use, and if you can have an extra hour of a nurse or a doctor, that's one more patient, that's one more scan, that's one more sequence in the care paradigm, and you end up there's more surgeries, so at higher margin and higher revenue per. So I'm pretty bulled up on. I'm trying to get as many providers with high fixed cost structures, like we're already long HCA and UHS and Acadia. I'm doing some work on Tenet. I think I might have missed it on Brookdale and Ensign. But I like that. I like that whole provider thing. And then there's an additional piece, which would be, any of these consolidators, like people that can, the roll-ups, right? Like roll-up might be a good time for that because you've got this, this ebb in, the private equity backed roll-ups kind of stuff. Like now the strategic, is going to be buying things at 4 times trailing EBITDA instead of 10. And, there's a whole host of companies that we were short in the past that, now that incremental inorganic growth is going to be cheaper, and that's good in a rising organic environment. So, and that's where you really can get paid on some things, is where if the base business is accelerating, plus I get a little juice from M&A, plus a little margin expansion. Those are the kind of stories that people, put very big TAMs and silly multiples on at some point. So I'm happy to try to get in front of some of those. Got a few in the hopper on that. And I'm trying to reach out to some folks that I've talked to in the past who are broker those types of deals, just to hear that firsthand comment, like, oh yeah, deals are deals were trading at 10 times trailing, and now they're trailing at 6. I'd like to hear that for real before we kind of make that jump. But yeah, and then on Progeny, did he short Progeny today? I didn't see.
Yeah, I think he did.
Okay. Yeah, I mean that's the other side, right? Like that's benefits, employment. That's a way to play tech imploding. I think the TAM is much smaller. It's fertility benefits. I think utilization is going to go down, so that's going to hurt their pharmacy business. But we've sort of done 85% of what we could possibly ever do, and so we're slowly adding. And from a quad factor exposure, it's really very, very vulnerable, which is why I think when they said in their press release, hey, things are really good, things are quote unquote strong, new business and utilization, I think with that not really getting the stock to move is sort of part and parcel of what we're talking about, which is this stock, if it breaks on the estimate momentum at all, like it's like a hair's width away from absolutely getting crushed, from trading at 100 times earnings today, 57 times next year. Consensus is too high. That thing could crack, many, many, many turns lower.
Yeah, awesome. I appreciate it, Tom. Anybody got any questions for Dr. Tobin? For Tommy? Brian, you always got questions.
No, I'm good.
Right. Brian, don't take it personally, Tom. Brian owns zero equity.
No, that's cool. I
Brian
appreciate you calling me.
So but yeah,
I don't invest in healthcare credits. Like I don't like on a fixed income basis. So it doesn't. Remember my space? I only do.
I know. I'm very familiar. I was
education, government, utilities. I don't do healthcare.
I got you. All right. Well, we are about an hour. What are we? We're about an hour and 45 in. So, if anybody's got any additional kind of commentary or points, I mean, we may just wrap it up with Tom there.
Hey, yeah. Robert, I just wanted to say the reason I brought up the trade and trend is because I see so many people only trading, and I get all the products. So I watched Macro Pro, and what you'll notice is if you're only looking at RTAs and you wait and you say, oh, Keith's finally shorting Qs, but in the Macro Pro, it's a core short. It may just be the smallest ranked position, but it's always in there. And I think some people don't realize that because they're not understanding like a core position that's got a longer duration to it versus the shorter trade. That's the reason I brought it up.
No, Brian, it was a great question, and I hope I answered it okay. And I certainly wasn't trying to get my panties in a knot at all. But it's a really good. It's something that is kind of misunderstood, and you're spot on there, Brian. In terms of obviously, again, you can't. I understand not everybody can get access to everything, but we do certainly try our best to share and show kind of the moves that we're making and how we're working on positioning our portfolio. And Keith, absolutely right. Those core products, those core asset allocations inside of the Mucker family offices, which is Brian is referring to, which is our re-rank product. There's components in there like SQQ and UUP that have been in there. I'm just approximating here, approximately like 12 months, right? So they've been in there for at least 12 months. And so, that's definitely, we were in gold early last year, and then it got booted, and then we got back into it in November timeframe. So, the biggest thing, and I've talked about this a couple of times, I think, but the biggest thing with the re-rank when I first got access to it over a year ago was the seeing how he does incrementally touch the positions. It helped me so much in terms of understanding, how he moves his inventory up and down, right? And really, and to really think about it in a very almost like agnostic, very unemotional way, never being tied to a particular, to a particular asset, and really thinking about them as inventory. He even came on one of our spaces, or my spaces here in might have been even this time last year, or kind of early of 2022, or might have been late 21, and really express it in that way in terms of thinking about what's inside of your portfolio in regards to pieces of inventory. And if something's not selling off those shelves, then get rid of it, right? Put it on deep discount and get it the fuck out. But if something is going out like gangbusters and is bullish trading trend like gold or GDX has been in certainly recent weeks, and has been if you look back on a where's GDX is up like 28% on a 1 month basis, right? So I mean, talk about outperformer. So yeah, I mean, something like that is in there in that inventory. You want to have as much of that inventory as possible, but again, defined in regards to your position sizing and what's good for your risk tolerance, what's good for your risk management, what's good to achieve your goals, and that's the big thing.
Amen, brother.
Buddy. Awesome. Let's wrap up on that. Appreciate everybody's awesome commentary this afternoon. Tom, Tobin, thank you for jumping up. I'm going to have a special announcement later this evening for Hedgeye Live. That is on in a couple of weeks here in that first week of May. I'm going to be announcing all of the kind of our invites. So there's going to be 4 individuals and 2 RAs that we're extending an invite, and really looking forward to making that announcement. So I see a couple of them out there in the crowd right now. But again, thank you for another great session of Weekly Notebook Review. I'm on holiday next week, going to be in Jamaica. There is a slight probability that I will host a Weekly Notebook Review on Wednesday at 4:30, but it's pretty unlikely. So we may just see you the following week, and I will come live from Atlanta. So we'll keep you all posted there. But again, be safe out there. Keep those emotions at bay, and just kind of execute on your process. All the best.